Let me explain something to you about Subway, because what happened to this company is not just about sandwiches. It's not just about business decisions gone wrong. What happened to Subway is a textbook case of how capitalism works, how it organizes production, how it distributes wealth, and ultimately how it collapses under the weight of its own internal contradictions. And I say that because when you look at the Subway story, when you really examine what happened, you see everything you need to understand about the franchise model, about exploitation, about who wins and who loses in our economic system. Now, here's what you need to understand from the very beginning. Subway didn't fail because people stopped eating sandwiches. Subway didn't fail because of one bad decision or one incompetent executive. Subway failed because the business model itself, the franchise model that everybody celebrates, was designed from the ground up to extract wealth from people at the bottom and concentrate it at the top, period. That's what it was designed to do. And for a while, it worked brilliantly for the people at the top. But like all such systems built on extraction rather than sustainability, it eventually ate itself alive. Let's go back to the beginning because the story of Subway starts, like so many American business stories, with a small operation that grows and grows and grows. In 1965, a 17-year-old kid named Fred DeLuca borrowed $1,000 from a family friend, a nuclear physicist named Peter Buck. They opened a submarine sandwich shop in Bridgeport, Connecticut. They called it Pete's Super Submarines. Now, that's not particularly relevant, except to understand that this was, at the beginning, a small family business. Two people, one location, making sandwiches. But here's where it gets interesting. By 1974, they had 16 locations, and this is when they made the decision, the crucial decision that would define everything that came after. They decided to franchise. Now, let me be very clear about what that means. Franchising is not just a way to grow a business. Franchising is a specific relationship of economic power. The franchisor, the company at the top, owns the brand, the systems, the intellectual property. The franchisee, the person who actually runs the store, who works 12, 14 hours a day, who puts up their life savings as collateral, that person owns almost nothing. They rent the right to use the brand. They pay for that privilege, and they take on all the risk. And here's the question nobody wants to ask. Who benefits from this arrangement? Well, the franchisor benefits immediately. They get franchise fees. They get royalty payments calculated as a percentage of gross sales, not profits. You understand, gross sales. So even if the franchisee is losing money, even if the franchisee is going bankrupt, the franchisor gets paid. The franchisor also benefits because they can grow rapidly without putting up much of their own capital. The franchisee provides the capital, the franchisee signs the lease, the franchisee takes out the loans, the franchisor just collects the fees and counts the number of locations. Now, how did we get here? How did we get to a system where this seems normal, where this seems like just another business model? We got here because under capitalism, the drive for expansion, the drive for growth becomes more important than the actual health of the underlying enterprises. Subway's executives didn't wake up every morning thinking, how can we make sure our franchisees are profitable? How can we ensure our workers are paid well? How can we create sustainable businesses in communities across America? No. They woke up thinking, how many new stores can we open this quarter? How fast can we grow? How do we maximize our franchise fees and royalty streams? And let me tell you what happened as a result. Subway grew at an astonishing rate. By the early 2000s, Subway had become the largest restaurant chain in the world by number of locations. Larger than McDonald's, larger than Starbucks. At its peak, Subway had more than 44,000 locations worldwide. 44,000. In the United States alone, there were more than 27,000 Subway restaurants. That's more Subway locations than the total number of McDonald's, Wendy's, and Burger King locations combined. Now, you might think, well, that's success. That's the American dream realized. A small sandwich shop becomes a global empire. But here's what that story leaves out. Here's what they don't tell you in the business schools and the Chamber of Commerce meetings. That expansion, that rapid growth, that relentless push for more and more locations, it came at a terrible cost. And the people who paid that cost were not the executives at Subway headquarters. The people who paid that cost were the franchisees and the workers. Let me explain how the cannibalization worked, because this is crucial to understanding the whole story. Subway's growth strategy was based on a very simple principle: open as many stores as possible, as quickly as possible, wherever possible. And if that meant opening a new Subway 3 blocks away from an existing Subway, well, that was just fine with corporate headquarters. Why? Because corporate headquarters got paid every time a new franchise opened. They got the franchise fee, which could be $10,000 to $15,000. They got a share of the equipment sales. They got ongoing royalty payments calculated as a percentage of that new store's gross sales. But what happened to the existing franchisee, the one who was already there, the one who had invested their life savings, the one who was barely making ends meet? Their sales got cut. Their customer base got divided. Their profit margin, if they had one, disappeared. And when they complained to corporate headquarters, when they said, "You're destroying my business by opening a store right next to me," what do you think the response was? The response was essentially, "Too bad. Read your franchise agreement. We have the right to open stores wherever we want." That should make you very angry, because what that reveals is the fundamental relationship at the heart of the franchise model. The franchisee has no power. The franchisee has no vote. The franchisee is not a partner. The franchisee is a revenue source for the franchisor, nothing more. And when the franchisee's interests conflict with the franchisor's interests, the franchisor wins every single time. Now, Subway will tell you, and their defenders will tell you, that franchisees knew what they were getting into. They signed a contract, they had lawyers, they made a choice. And there's a grain of truth in that, but it misses the larger point. The larger point is that we have created an economic system in which people who want to start a business, people who want to be their own boss, people who want to build something, we've created a system where their only option or their best option is to enter into a relationship where they have no power, where they take all the risk, and where the terms are dictated entirely by the corporation. This is not freedom. This is not entrepreneurship. This is a new form of economic dependency, and Subway perfected it. Now let's talk about the numbers, because the numbers tell you everything you need to know about how this system operates. At the height of Subway's expansion, the company was opening, on average, more than 1,000 new locations every single year. 1,000. Think about what that means. That means somewhere in the world, nearly 3 new Subway restaurants were opening every single day. Every day. Weekends, holidays, it didn't matter. The growth machine never stopped. And here's what you need to understand about those numbers. Every one of those new franchisees, every single person who signed on to open a Subway, they believed in the American dream. They believed that if they worked hard, if they followed the rules, if they did everything the corporation told them to do, they would succeed. They would build equity. They would create wealth for themselves and their families. That's what they were promised. That's what the whole franchise model promises. But the reality, the actual lived experience of most Subway franchisees was completely different. And this brings me to the financial structure of the franchise agreement, because this is where the exploitation becomes mathematical. When you open a Subway franchise, you're looking at an initial investment of somewhere between $150,000 and $300,000, depending on the location, the size of the store, whether you're building from scratch or taking over an existing location. That's a lot of money. For most people, that's their life savings. That's a second mortgage on their house. That's loans from family members. That's everything they have. And what do they get for that investment? They get the right to operate a Subway restaurant according to Subway's rules, using Subway's systems, buying supplies from Subway's approved vendors, and paying Subway 8% of their gross sales in royalties, plus another 4.5% for advertising. That's 12.5% of gross sales going to corporate before the franchisee pays for rent, before they pay for labor, before they pay for food costs, before they pay for utilities, insurance, maintenance, everything else. 12.5% off the top, period. Now, in the restaurant industry, many economists argue that a successful operation needs to maintain food costs at around 30% of sales and labor costs at around 30% of sales. That's just the baseline to be viable. Add in rent, which in many urban locations can be 10 to 15% of sales, and you're already at 70 to 75% of revenue spoken for. Then you add that 12.5% to corporate, and suddenly you're at 85% of revenue committed before you even start talking about utilities, equipment maintenance, insurance, cleaning supplies, accounting fees, and all the other costs of running a business. What does that leave the franchisee? In a good year, in a really good year, a Subway franchisee might make 10 to 15% profit margin, but that's in a good year. In an average year, many franchisees are making 5 to 8%. And in a bad year, which is most years for most locations, they're losing money. They're going into debt. They're falling behind on their rent. They're cutting corners on food quality. They're understaffing the store. They're working 16-hour days themselves just to keep the doors open. And here's the question nobody wants to ask. If the franchisees are struggling, if they're barely breaking even or losing money, how is Subway as a corporation doing? Well, Subway as a corporation is doing great, because remember, Subway gets paid on gross sales, not on profits. If a franchisee does $1 million in sales and loses $50,000, Subway still gets their $80,000 in royalties and another $45,000 in advertising fees. Subway got paid $125,000 from a franchisee who lost money. That's the beauty of the system from the corporation's perspective. The franchisee's failure is not Subway's problem. The franchisee's bankruptcy is not Subway's loss. The franchisee goes under. Subway just finds another franchisee, another person with savings and hope and belief in the American dream, and the cycle continues. Now, how did we get here? How did we get to a point where this seems normal? Let me tell you something about the history of franchising in America, because this didn't happen by accident. The franchise model really took off after World War II in the 1950s and 1960s, when you had this massive expansion of consumer culture, suburban development, and highway construction. Companies realized they could grow nationally very quickly by getting other people to put up the capital and take the risk. And the government supported this. The Small Business Administration made loans available for franchisees. The courts generally sided with franchisors in disputes. The legal and regulatory framework was built to facilitate rapid expansion of franchise systems. Why? Because it looked like entrepreneurship. It looked like small business ownership. It looked like the American dream, but it wasn't. It was a new form of corporate control, a new way to extract wealth from working people and small business people and concentrate it in corporate headquarters. Now back to Subway. As the company continued to grow through the 1980s, 1990s, and 2000s, something interesting happened. The quality of franchisees changed. In the early days, Subway could be selective. They could find franchisees with significant capital, with business experience, with the ability to weather tough times. But as they accelerated their growth, as they pushed for more and more locations, they lowered their standards. They started approving franchisees who were less capitalized, less experienced, more desperate. And this created a vicious cycle. Less experienced franchisees were more likely to struggle. Their stores performed worse. They cut more corners. The brand suffered, but Subway didn't care because they were still collecting their fees. In fact, in some ways, they benefited from franchisee turnover. When a franchisee failed and sold their store, Subway collected fees from the new franchisee. When a franchisee closed and another location opened nearby, Subway collected another initial franchise fee. The churn itself became a revenue source. Let me be very clear about what that means. Subway's business model evolved to the point where franchisee failure was not a bug, it was a feature. The system wasn't designed to create 50,000 successful small businesses. The system was designed to create a constant stream of new franchisees, each paying their fees, each generating their royalties, each eventually burning out and being replaced by the next dreamer with a checkbook. And nobody voted on this. Nobody elected the executives at Subway headquarters and said, yes, we want you to organize our economy this way. We want you to create a system where risk flows downward and profit flows upward. This happened because under capitalism, the people who own and control capital get to make these decisions unilaterally. The franchisees don't get a vote. The workers don't get a vote. The communities where these stores operate don't get a vote. The decisions are made by a tiny group of people at the top whose only obligation is to maximize their own wealth extraction. That's the story you need to understand. Because what happened at Subway is happening across the American economy. It's happening in franchising, it's happening in supply chains, it's happening in labor markets. Everywhere you look, you see the same pattern. Concentration of power at the top, extraction of wealth from the bottom, and when the system collapses, the people at the top walk away rich while everyone else is left holding the bag. Now we need to talk about the workers because no discussion of Subway's collapse would be complete without understanding what happened to the people who actually made the sandwiches, who actually served the customers, who actually did the work that generated all those sales that Subway corporate extracted their percentages from. And what happened to those workers reveals everything about how capitalism functions at the point of production. Let me start with a basic fact. The vast majority of Subway workers, we're talking about probably 90% or more, are paid minimum wage or very close to it. In most states, that means somewhere between $7.25 and $15 an hour, depending on local laws. Now, think about what that means in practical terms. A full-time minimum wage worker in most of America, working 40 hours a week, 52 weeks a year, is making somewhere between $15,000 and $30,000 a year before taxes. That's not a living wage. That's poverty. That's government assistance. That's working full time and still qualifying for food stamps. And here's the beautiful thing from the franchisee's perspective and from Subway corporate's perspective, that worker is producing way more value than they're being paid. Think about it. A Subway sandwich sells for $8 to $12. The actual labor time to make that sandwich is maybe 3 to 5 minutes. So in an hour, a worker can produce 12 to 20 sandwiches. That's somewhere between $96 and $240 in sales per hour. And the worker is being paid $8 to $12 for that hour. Where does the rest of the money go? Well, some of it goes to food costs. about $3 per sandwich on average. Some goes to rent, some goes to utilities and other overhead. Some goes to Subway corporate as royalties and advertising fees. And what's left, if anything, goes to the franchisee as profit. But notice what's happening here. The worker, the person actually creating the value, the person whose labor is the source of all the revenue, that person is getting a tiny fraction of the value they produce. The rest is being extracted by the franchisee and by Subway corporate. Now, you might say, well, that's how businesses work. The worker gets a wage and the owner gets the profit. And yes, that is how businesses work under capitalism. But let me ask you a question. Who decided it should work that way? Did the workers vote on this arrangement? Did they collectively sit down and say, yes, we agree that we should produce all this value and receive only a small fraction of it, while the rest goes to people who don't make the sandwiches? Of course not. This arrangement was imposed on them. They accept it because they need a job, because they need to eat, because they need to pay rent, because the alternative is unemployment and destitution. And here's where it gets even more exploitative, because Subway franchisees, remember, they're squeezed by Subway corporate. They're paying 12.5% off the top. They're dealing with oversaturation and cannibalization. They're struggling to stay profitable. So what do? They squeeze the workers even harder. They cut hours. They understaff the stores. They pressure workers to work faster. They avoid giving raises. They fight against any effort to unionize or collectively bargain. Because from the franchisee's perspective, labor cost is the one thing they have some control over. They can't control their royalty payments to corporate. They can't control their rent, but they can control how many workers they schedule and what they pay them. So you end up with this situation where Subway workers are working in understaffed stores, often alone during shifts, rushing to serve customers, unable to take proper breaks, making poverty wages with no benefits, no job security, no prospects for advancement. And if they complain, if they ask for better treatment, they're told, if you don't like it, there's the door. We can replace you tomorrow. Now, let me tell you what this does to the quality of the product and the quality of the customer experience, because this is where the whole system starts to visibly break down. When you have underpaid, overworked, demoralized workers, they're not going to give you their best effort. They're not going to care deeply about food quality. They're not going to go the extra mile for customers. They're going to do the minimum necessary to not get fired. And who can blame them? If you're paying someone $8 an hour and working them like a dog, you cannot expect them to treat your customers like royalty. You cannot expect them to maintain pristine food safety standards. You cannot expect them to be cheerful and enthusiastic brand ambassadors. And so what happened? Throughout the 2000s and 10s, as Subway continued its aggressive expansion, as franchisees got more squeezed, as workers got paid less and worked harder, the quality of the Subway experience deteriorated. Customers started noticing the lettuce wasn't as fresh, the bread was inconsistent, the stores weren't as clean, the service was rushed and impersonal, and Subway's reputation began to suffer. Now, Subway corporate responded to this with marketing. They brought in celebrity spokespeople. They ran advertising campaigns. They introduced new menu items. But here's what they didn't do. They didn't address the fundamental structural problems that were causing the quality decline. They didn't give franchisees relief from their royalty payments. They didn't stop oversaturating markets. They didn't ensure workers were paid a living wage, because doing any of those things would have reduced the wealth extraction flowing to corporate headquarters. And this brings me to a larger point about how capitalism operates. Under capitalism, the response to problems created by exploitation is never to reduce the exploitation. The response is always to find new ways to manage the symptoms, to paper over the contradictions, to distract from the underlying reality, quality declining, spend more on marketing, workers miserable, institute a customer service training program, franchisees failing, offer them loans at interest so they can dig themselves deeper into debt while continuing to pay royalties. Let me give you a specific example of how perverse this got. During the 2000s, Subway introduced a $5 foot-long promotion, $5 for a 12-inch sandwich. This became incredibly popular with customers. It drove traffic to stores. It became part of Subway's brand identity. But here's what that promotion did to franchisees. It destroyed their margins. Remember, Subway corporate still got their 8% royalty on that $5 sale. The franchisee still had to pay for the food, the labor, the rent, all the other costs. On a $5 foot long, many franchisees were losing money on every sandwich they sold. They were literally paying customers to take food. And when franchisees complained about this, when they said, "This promotion is killing us," what did Subway corporate say? They said, "It's bringing in customers. It's building the brand. You need to find ways to be more efficient." More efficient. That's the code word. That means pay your workers less, cut more corners, use cheaper ingredients, work harder yourself. Because Subway corporate wasn't going to reduce their royalty percentage. They weren't going to subsidize the promotion. They created a situation where franchisees had to choose between participating in a money-losing promotion or defying corporate and risking their franchise agreement. This reveals everything about how capitalism works. The corporation at the top creates policies that benefit themselves. Those policies harm the people below them in the hierarchy. And then, when problems emerge, the solution is always for the people below to sacrifice more, to work harder, to accept less. Never does the solution involve the people at the top accepting lower profits or sharing power or restructuring the relationship to be more equitable. Now, I want to make something very clear. The workers at Subway, the franchisees at Subway, these are not stupid people. These are not lazy people. These are people who got caught in a system that was designed to exploit them. They worked hard. They followed the rules. They did everything they were supposed to do, and the system failed them anyway, because the system was never designed to serve their interests. It was designed to extract wealth from them and concentrate it at the top. And when you understand this, when you really see how this works, you start to realize that the Subway story is not unique. It's happening everywhere. Every time you see a franchise system, every time you see a supply chain, every time you see an employment relationship under capitalism, you're looking at some version of this same dynamic. The people at the top structuring things to extract maximum value from the people below. And when the system breaks, the people at the top walk away rich while everyone else suffers. Now let's talk about the 2010s, because this is when the whole rotten structure started to become visible, when the contradictions became impossible to ignore, when the decline accelerated. And I want you to understand why this happened when it did, because timing matters. Economic systems don't collapse randomly. They collapse when the internal pressures and contradictions reach a breaking point. By 2012, 2013, Subway had reached peak saturation in the United States. Remember, they had more than 27,000 locations. That's one Subway for every roughly 12,000 Americans. Think about that. One Subway for every small town. One Subway in every mall, every strip mall, every gas station, every airport, every college campus. There was literally nowhere left to expand domestically without cannibalizing existing stores. And this created a massive problem for Subway's business model, because remember, Subway's growth had been driven by opening new franchises. That's where they got their franchise fees. That's how they showed growth to investors and lenders. That's how the executives at the top justified their compensation. But now suddenly the growth machine was running out of room. And when a business model is predicated on constant expansion, when it's built on growth rather than sustainability, what happens when you can't grow anymore? You start to contract. And that's exactly what happened. Between 2012 and 2020, Subway closed more than 7,000 locations in the United States. 7,000. Now, let me be clear about what that means. That's 7,000 franchisees who failed, 7,000 people who lost their investment, 7,000 people who went into debt, 7,000 bankruptcies, foreclosures, ruined credit scores, destroyed dreams. And who do you think bore that loss? Not Subway Corporate. Subway Corporate had already collected their fees. They'd already taken their royalties. The franchisees bore the loss, period. And here's what's even more revealing. During this same period, even as they were closing thousands of stores, even as franchisees were failing left and right, Subway Corporate remained profitable. They were still collecting royalties from the stores that remained open. They were still licensing the brand internationally. The executives were still getting paid. The company was still worth billions, because the franchise model insulates the corporation from the failures of individual franchisees. Each franchisee is a separate business entity. When they fail alone. The corporation continues. Now, you might ask, why did these stores start failing at such an accelerated rate in the 2010s? And the answer is complicated, but it comes down to several interconnected factors. First, there was the oversaturation we've already talked about. Too many stores competing with each other. Second, there was the quality decline we discussed, which drove customers away. Third, there was increased competition from other fast casual restaurants like Chipotle, Panera, and others that were offering perceived higher quality at similar or slightly higher prices. And fourth, there was a fundamental shift in consumer preferences toward fresher, healthier, more authentic food experiences. But here's what's crucial to understand. All of these factors were predictable consequences of Subway's business model. The oversaturation was the direct result of corporate's growth at all costs strategy. The quality decline was the direct result of squeezing franchisees and underpaying workers. The competitive disadvantage was the direct result of failing to invest in the stores and the brand. And the shift in consumer preferences was something that Subway could have anticipated and adapted to if they had been focused on long-term sustainability rather than short-term extraction. Let me give you an example of how backwards the incentives were. When a Subway store was failing, when it was losing money, corporate's response was not to reduce the royalty payments to give the franchisee breathing room. Their response was not to reduce the advertising fees. Their response was to remind the franchisee of their contractual obligations, and in many cases, to pressure them to sell to another franchisee or to convert to a different store format. Because from corporate's perspective, a struggling franchisee was a problem only insofar as they might stop paying their fees. The solution was to replace them with someone new who would keep the payments flowing. And this gets to something really important about power dynamics under capitalism. The franchisee signed a contract. They agreed to the terms. But what choice did they really have? If you want to run a sandwich shop, if you want to get into the restaurant business, you have essentially three options. You can start completely from scratch, which is incredibly risky and capital intensive. You can buy an existing independent restaurant, which is also risky and may not be available. Or you can buy a franchise, which gives you a proven system, brand recognition, and support. For many people, the franchise option seems like the safest bet, the smart choice. But what they don't realize, what they can't fully appreciate until they're in it, is that they're entering into a relationship of fundamental inequality. They're signing a contract that gives them responsibilities but very few rights. They're committing their capital and their labor to building someone else's brand, someone else's empire, and the contract they sign, let me tell you, that contract was not negotiated. That contract was written by Subway's lawyers to protect Subway's interests. The franchisee can take it or leave it. They cannot change it. They cannot bargain over it. It's adhesion, pure and simple. Now, as more and more franchisees failed, as the collapse accelerated, some of them started to organize. They formed franchisee associations. They hired lawyers. They filed lawsuits. They went public with their grievances. And what were their main complaints? First, they complained about the oversaturation, about Subway opening new stores that destroyed their existing stores' profitability. Second, they complained about being forced to participate in promotions like the $5 footlong that lost them money. Third, they complained about Subway's approved vendor requirements that forced them to buy supplies at inflated prices. Fourth, they complained about Subway's rigid operational requirements that didn't allow them to adapt to local market conditions. These were legitimate grievances. These were real structural problems. But here's what happened when franchisees raised them. Subway fought back. They used the franchise agreements as weapons. They threatened non-renewal. They threatened litigation. They reminded franchisees that they had signed contracts and needed to live up to their obligations. In some cases, they made examples of franchisees who were particularly vocal, who were organizing others, who were threatening the system. And this reveals something crucial about how power operates under capitalism. It's not enough for the corporation to have economic power. They also need legal power, political power, ideological power. They need contracts that protect them. They need courts that enforce those contracts. They need a regulatory system that allows them to operate as they do. They need a culture that valorizes entrepreneurship and treats business failure as individual weakness rather than systemic exploitation. And they have all of those things. Think about the media coverage of Subway's decline. What was the narrative? The narrative was about changing consumer tastes, about Subway failing to innovate, about bad marketing decisions, about the damage from the Jared Fogle scandal. All of those things are true, but they're superficial. They're symptoms, not causes. The real story, the structural story, the story about exploitation and extraction and the inevitable collapse of unsustainable business models, that story was largely untold because that story would require questioning capitalism itself, and that's not something mainstream media is willing to do. Now, I mentioned the Jared Fogle scandal, and I need to address it briefly because it did have an impact. For years, Subway's primary spokesperson was Jared Fogle, a man who claimed to have lost hundreds of pounds eating Subway sandwiches. He was the face of the brand, and in 2015 he was arrested and convicted of sex crimes involving minors. Terrible, disgusting crimes. And this obviously damaged Subway's brand. But here's what I want you to understand. The Jared Fogle scandal did not cause Subway's structural problems. It accelerated the visible decline, but the underlying rot was already there. Subway was already oversaturated. Franchisees were already struggling. Quality was already declining. Workers were already underpaid. The business model was already unsustainable. Jared Fogle's crimes gave customers an emotional reason to avoid Subway, but the rational reasons were already mounting. And Subway's response to the scandal is instructive. They cut ties with Fogle immediately. They launched new marketing campaigns with new spokespeople. They tried to move past it, but what they didn't do was address the fundamental problems with their business model. They didn't restructure the relationship with franchisees. They didn't pay workers better. They didn't stop oversaturating markets. They just tried to rebrand, to put a new face on the same broken system. And it didn't work because the problems were structural, not cosmetic. Now, let's talk about ownership and control, because this is where the Subway story gets really interesting from a political economic perspective. For most of Subway's history, the company was privately held by two people, Fred DeLuca, the co-founder, and Peter Buck, the nuclear physicist who loaned him that initial $1,000. This is important. This is crucial to understanding how decisions got made. When a company is publicly traded, when it has shareholders, there's at least some level of accountability, some level of transparency. The company has to file reports. It has to hold shareholder meetings. Analysts scrutinize the numbers. There's pressure from institutional investors. Now, don't get me wrong, publicly traded companies are still fundamentally organized around maximizing shareholder value, which means maximizing exploitation of workers and extraction of wealth. But there's at least some visibility, some external oversight. But Subway was private. Fred DeLuca and Peter Buck owned it. They controlled it. They made all the decisions, and they didn't have to answer to anyone. They didn't have to disclose their profits. They didn't have to justify their executive compensation. They didn't have to explain their growth strategy to anyone except themselves. This gave them enormous power, enormous freedom to run the company however they wanted. And how did they choose to run it? They chose to pursue aggressive expansion, maximum extraction, and concentration of wealth at the very top. Fred DeLuca, in particular, was known for his aggressive, growth-oriented approach. By all accounts, he was obsessed with making Subway the largest restaurant chain in the world, and he achieved that goal. He did it. Subway became #1 by store count. But at what cost? At the cost of franchisee profitability, at the cost of worker welfare, at the cost of food quality, at the cost of long-term sustainability. He built an empire, but he built it on sand. And here's something that should make you very angry. Fred DeLuca died in 2015 a billionaire. His personal wealth was estimated at somewhere between $2 and $3 billion. $2 to $3 billion that came from the royalties and fees paid by franchisees extracted from the labor of minimum wage workers, accumulated over decades of running an exploitative business model. And when he died, that wealth didn't get distributed to the franchisees who had struggled. It didn't go to the workers who had been underpaid. It got inherited by his family according to estate planning that no doubt minimized tax obligations. Peter Buck, the other co-founder, also died a billionaire. His estate was estimated at $1.5 billion. So between the two founders of Subway, we're talking about wealth accumulation of $4 to $5 billion. $4 to $5 billion extracted from the bottom, concentrated at the top, passed on through inheritance to people who never made a sandwich, never ran a store, never did anything except be born into the right family. This is capitalism working exactly as it's designed to work. The people who own the business, who control the means of production, they accumulate vast wealth, not through their own labor, not through some unique genius, but through their ownership rights, through their ability to extract value from other people's labor, through their structural position in the economic system. Now, after Fred DeLuca died, ownership of Subway passed to his widow and his family through a family trust. And this is when things got even more complicated, because the family didn't have Fred's operational experience or his vision, such as it was. They were owners of an asset, a very valuable asset, but they weren't operators. And so they brought in professional management, hired executives, brought in consultants. And what did these new managers do? They tried to turn things around, but they tried to do it within the same basic structure, the same basic business model that had created all the problems in the first place. They launched new marketing campaigns, they tried to refresh the menu, they experimented with new store formats, they invested in digital ordering and delivery partnerships. All of these things on the surface seem like reasonable responses to a declining business, but none of them address the fundamental structural problems. None of them change the relationship between franchisor and franchisee. None of them reduce the royalty burden. None of them stopped the cannibalization. None of them ensured workers were paid a living wage. And why didn't they address these fundamental issues? Because to do so would have required reducing the wealth extraction flowing to the owners. It would have required accepting lower profits. It would have required restructuring power relationships. And that's not something capitalist enterprises do voluntarily. The whole point of owning a business under capitalism is to extract maximum return on your investment. If you're the owner of Subway, your goal is to maximize the value of your asset, to maximize your dividends, your distributions, your eventual sale price. The welfare of franchisees and workers is simply not part of your decision-making calculus, except insofar as it affects your bottom line. Now, let me tell you what happened next, because this is where the story gets really revealing. In 2021, after years of decline, Subway hired a new CEO, a man named John Chidsey. And Chidsey came from the private equity world. He'd previously run Burger King, which had been taken private by a private equity firm. And what did Chidsey do at Subway? He started preparing the company for a sale. Think about what that means. The company is struggling. Franchisees are failing. Stores are closing. The brand is damaged. Workers are underpaid. The business model is broken. And the response from ownership is not to fix these problems, not to restructure the business for sustainability, but to prepare it for sale, to make it attractive to potential buyers, to maximize the exit price for the current owners. And in 2023, that's exactly what happened. Subway was sold to a private equity firm called Rourke Capital for $9.5 billion. $9.5 billion. Now let that sink in. The DeLuca family trust, which had inherited this company, which had watched it decline, which had done nothing to address the fundamental problems, they walked away with nearly $10 billion. $10 billion in wealth that was created by franchisees and workers, extracted through exploitation, and ultimately cashed out by owners who contributed nothing except their ownership claim. And who is Rourke Capital? They're a private equity firm that specializes in restaurant chains and franchise systems. They own Dunkin', Baskin-Robbins, Buffalo Wild Wings, Arby's, and many others. They're experts at the franchise model. They're experts at financial engineering. And what do you think they plan to do with Subway? Do you think they're going to restructure it to benefit franchisees and workers? Do you think they're going to reduce royalty rates and pay living wages and prioritize long-term sustainability? Of course not. They're going to do what private equity firms do. They're going to cut costs, squeeze efficiency, extract maximum cash flow, and eventually sell it to someone else at a profit. This is the logic of financialized capitalism. Companies become assets to be traded, not productive enterprises to be sustained. The goal is not to make a good product, not to serve a community, not to provide good jobs, but to maximize financial return for owners and investors. Everything else is secondary. And here's the question nobody wants to ask. Who elected Rourke Capital? Where is the vote? The franchisees didn't vote on this sale. The workers didn't vote on it. The communities where Subway operates didn't vote on it. The sale was decided by the owners and their bankers and their lawyers behind closed doors in private negotiations. And now Rourke Capital owns Subway. They control it. They'll make all the decisions about its future, and the rest of us, we just have to live with the consequences. This is economic dictatorship. This is what democracy looks like when it stops at the workplace door. We have political democracy. We get to vote for government officials, but we have economic dictatorship where all the major decisions about production, employment, investment, and distribution are made by a tiny elite that owes no accountability to anyone except themselves and their fellow investors. And the subway story illustrates this perfectly. At every stage, at every decision point, the people with power, the owners, the executives, the corporate headquarters, they made decisions that benefited themselves at the expense of franchisees, workers, and customers. And they were able to do so because the system gave them that power. The franchise agreements gave them that power. The legal structure gave them that power. The private ownership gave them that power. And when the whole thing started to collapse, when the consequences of their decisions became undeniable, they just sold the company and walked away rich. That should make you very angry because this is not an anomaly. This is not a bug. This is the system working as designed. This is capitalism. This is how wealth is created and concentrated under our current economic system. And until we change that system, until we democratize economic decision making, until we restructure ownership and control, we're going to keep seeing the same story play out over and over again across different companies, different industries, different sectors of the economy. Now I want to talk about alternatives, because when you criticize capitalism, when you point out how exploitative and unsustainable these systems are, people always ask, well, what's the alternative? How else could this work? And those are fair questions, and they deserve serious answers, because it's not enough to just critique what exists. We need to imagine and articulate how things could be organized differently, more democratically, more equitably, more sustainably. So let's think about how Subway could have been structured differently. Let's think about what a democratic cooperative version of Subway might have looked like, because these alternatives exist. Worker cooperatives exist. They function, they succeed. They're just not what capitalism promotes or what our economic system privileges. Imagine if Subway had been organized as a federation of worker cooperatives. Each store would be owned and democratically controlled by the workers at that store. The people who make the sandwiches, who serve the customers, who do the actual work, they would collectively own the enterprise. They would elect their own management. They would make decisions about hours, about wages, about working conditions. They would share in the profits that their labor generates. Not a tiny minimum wage fraction, but a fair share of the value they create. Now, how would such a system handle the benefits of coordination, brand recognition, purchasing power, shared marketing, all the things that a franchise system supposedly provides? Well, these worker-owned stores could federate. They could form associations. They could collectively negotiate with suppliers. They could pool resources for marketing. They could share best practices. But the crucial difference is that the power would flow from the bottom up, not from the top down. The individual cooperatives would be members of the federation, and they would democratically decide on the federation's policies. They would vote on royalty contributions. They would vote on expansion plans. They would vote on quality standards. And here's what would happen in such a system. You wouldn't get the oversaturation problem, because the existing cooperatives would vote against opening new stores that would cannibalize their own sales. Why would they vote to hurt themselves? You wouldn't get the quality decline, because the workers who own the stores have every incentive to maintain quality, to keep customers happy, to build a sustainable business. You wouldn't get the exploitation of workers, because the workers are the owners. They're exploiting themselves, which is a logical impossibility. Now, you might say, but would such a system grow as fast? Would it achieve the same scale? And the answer is probably not. And that's the point. Rapid growth for growth's sake is not the goal. Sustainability is the goal. Good jobs are the goal. Healthy communities are the goal. Quality products are the goal. And those goals are better served by democratic worker cooperatives than by exploitative franchise systems. Let me give you some real world examples, because this is not just theoretical. The Mondragon Corporation in Spain is a federation of worker cooperatives that includes manufacturing, retail, finance, and other sectors. It employs over 80,000 workers. It's been operating since 1956. It survived economic crises, recessions, global competition, and it's done so while maintaining democratic governance, relatively equal pay ratios, and commitment to community development. When Mondragon cooperatives face economic difficulties, they don't lay off workers. They collectively decide on temporary pay cuts or reduced hours shared by everyone. The decisions are made democratically and the sacrifices are shared equitably. Or look at cooperatives in the United States. There are thousands of them. Some are small, some are substantial. The Park Slope Food Coop in Brooklyn has over 17,000 members. Equal Exchange, a worker-owned coffee cooperative, has been operating since 1986. There are cooperative grocery stores, cooperative child care centers, cooperative factories, cooperative technology companies. They exist, they work. They're just a tiny fraction of the economy because capitalism doesn't promote them, doesn't finance them, doesn't teach about them in business schools. Now, bringing this back to Subway specifically, imagine if in the 1970s, when Fred DeLuca and Peter Buck decided to expand, they had chosen a cooperative model instead of a franchise model. Imagine if they had helped workers at each new location form cooperatives, if they had created a democratic federation, if they had built a system based on solidarity rather than exploitation. What would Subway look like today? It would probably be smaller. There might be 10,000 stores instead of 44,000 at peak, but those 10,000 stores would be healthy, profitable, sustainable. The workers would be paid well. They'd have benefits, they'd have job security, they'd have dignity. The quality would be high because the workers would take pride in their cooperative enterprises. The communities would benefit because the profits would stay local, would be distributed to local worker owners, would circulate in the local economy instead of being extracted to corporate headquarters. And here's the thing. We're not talking about some utopian fantasy. We're talking about practical, feasible, proven alternatives that already exist. The reason we don't have more of them is not because they don't work. It's because capitalism doesn't want them. Banks don't want to finance them because they can't be bought and sold as easily as traditional corporations. Business schools don't teach about them because they challenge the fundamental logic of capitalist accumulation. Wealthy investors don't promote them because they don't allow for the same concentration of wealth. The franchise model that Subway used, the model that led to its collapse, that model exists and dominates because it serves the interests of capital. It allows rapid expansion with other people's money and risk. It allows maximum extraction of wealth to the top. It allows owners to accumulate billions while workers make minimum wage. That's why it's the default. That's why it's what everyone does. Not because it's the best system for creating sustainable businesses or good jobs or quality products, but because it's the best system for concentrating wealth. Now, let me address another alternative that's often proposed. What if we had better regulations? What if we had laws that protected franchisees from oversaturation? What if we had higher minimum wages? What if we had stronger unions? What if we had better enforcement of labor standards? These are all good things. These are all improvements that would help, but they don't address the fundamental power imbalance at the heart of capitalism. You can regulate franchise agreements to prevent the worst abuses, but you still have an inherently unequal relationship where the franchisor has power and the franchisee doesn't. You can raise the minimum wage, which you absolutely should, but you still have a system where workers produce value and owners extract most of it. You can have unions, which are essential, but you still have a system based on the conflict between workers who want better wages and owners who want lower costs. The fundamental problem is the structure of ownership and control. As long as businesses are owned by a separate class of investors and capitalists, as long as the people who work don't control their own work, we're going to have exploitation. We're going to have systems that prioritize profit over people. We're going to have concentrations of wealth and power. We're going to have boom and bust cycles, oversaturation and collapse, quality decline, and worker misery. And here's what's so frustrating. Most people understand this at some level. Most people, if you ask them, do you think the economy should be organized to benefit working people, to create good jobs, to build sustainable communities? They'll say yes. But then they'll say, but that's just not how it works. That's not realistic. That's not capitalism. And they're right. It's not capitalism, but that doesn't mean it's not possible. That means we need to move beyond capitalism. The subway collapse is not a mystery that needs solving. It's not a puzzle. It's not the result of bad management or changing consumer tastes or bad luck. It's the predictable outcome of a business model based on exploitation and extraction. It's what happens when you prioritize growth over sustainability, when you concentrate power at the top, when you make workers and franchisees bear all the risk while owners take all the rewards. And it's going to keep happening in different companies and different industries until we fundamentally restructure how we organize economic activity. The question is not whether alternatives exist. They do. The question is whether we have the political will, the collective courage to fight for those alternatives, to build them, to demand them, to replace the current system with something better, because we can. History shows that economic systems change. Feudalism gave way to capitalism. Capitalism can give way to economic democracy. It's not inevitable. It requires struggle. It requires organization. It requires people understanding what the problem is and what the alternative could be. But it's possible. Now, let me bring this all together, because the subway story is not just about one company, one industry, one business model. It's a window into how our entire economic system functions, and more importantly, how it fails the vast majority of people. When you understand what happened to Subway, when you really see the structural dynamics at play, you begin to understand what's happening across the entire economy. Look around you. Look at the gig economy. Look at Amazon warehouse workers. Look at retail employees. Look at adjunct professors. Look at healthcare workers. Everywhere you look, you see the same pattern. Corporations and wealthy individuals organizing production in ways that extract maximum value from workers while giving them minimum compensation and zero power. You see risk and responsibility pushed down to the people at the bottom while profits flow up to people at the top. The franchise model that destroyed thousands of Subway franchisees is fundamentally no different from the independent contractor model that exploits Uber drivers and DoorDash delivery workers. It's the same logic. The company gets the benefits of expansion and brand recognition. The individuals wrongly classified as independent business owners take all the risk, provide all the capital, do all the work, and get a small fraction of the value they create. And when times get tough, when markets saturate, when profits decline, it's the people at the bottom who suffer while the corporation and its executives remain insulated. Now, here's what you need to understand about Subway's current situation under Rourke Capital's ownership. The company is still operating, stores are still open, sandwiches are still being made, but the fundamental problems have not been solved. Franchisees are still struggling, workers are still underpaid, the business model is still extractive. What's changed is that now the profits, whatever profits remain after years of decline, they're flowing to private equity investors instead of the DeLuca family trust. And private equity, let me be very clear about this. Private equity is an even more predatory form of capitalism than traditional corporate ownership. Private equity firms buy companies using borrowed money, debt that goes on the company's balance sheet, not the private equity firms. They then extract maximum cash flow from the company to pay down that debt and to generate returns for their investors. They often cut costs aggressively, which means cutting jobs, reducing quality, squeezing suppliers, raising prices. And then, after a few years, they sell the company to someone else, hopefully at a profit. The goal is not to build a sustainable business. The goal is to extract maximum financial return in the shortest possible time. So if you're a Subway franchisee under the new ownership, your situation has not improved. If anything, you should expect more pressure, more demands, more aggressive enforcement of operational standards, all designed to squeeze more cash flow out of the system. If you're a Subway worker, you should not expect better wages or conditions. You should expect continued pressure to do more with less. And this brings me to the larger point about where we are in capitalism's development. We're in an era of financialization where more and more of the economy is controlled not by people who make things or provide services, but by people who buy and sell financial assets, who engage in speculation, who extract wealth through ownership claims rather than through productive activity. Private equity is one manifestation of this. Hedge funds are another. Real estate investment trusts are another. All of these financial entities are buying up productive assets, companies, properties, infrastructure, and organizing them not for productive purposes, but for maximum financial return. And what does this mean for workers, for communities, for the economy as a whole? It means more instability. It means more inequality. It means more short-term thinking because financial capital is mobile in ways that productive capital is not. A private equity firm can buy a company, strip its assets, load it with debt, extract cash, and then walk away when it collapses. They face no consequences. The workers who lose their jobs face consequences. The communities that lose businesses face consequences, but the private equity firms, they just move on to the next deal. The Subway story is playing out across the economy. Toys R Us, bought by private equity, loaded with debt, bankrupted. Sears, bought by a hedge fund manager, stripped of assets, bankrupted. Countless hospitals, nursing homes, apartment buildings, newspapers bought by private equity, run for cash flow, degraded in quality, and either sold or shut down. This is not creative destruction. This is not market efficiency. This is predation. This is exploitation. This is extraction. And here's the question we need to ask. Is this the economy we want? Is this the system we want to live under? Because we have a choice. We're told we don't have a choice. We're told this is just how markets work. This is just the natural order of things. But that's ideology. That's propaganda. The economy is organized by human decisions, by laws and regulations and institutions and power relationships. All of those things can be changed if we have the will to change them. Look at what happened during the COVID pandemic. Suddenly, when it was necessary, when there was political will, governments could do things that we were told were impossible. They could send checks to people. They could institute eviction moratoriums. They could support small businesses. They could recognize essential workers. Now, they didn't do enough, and much of that support went to the wrong places, to big corporations and wealthy individuals. But the point is, when there's political will, when there's public demand, things can change quickly. So, what would it take to change the franchise model? What would it take to protect workers? What would it take to democratize economic decision making? It would take political organization. It would take working people coming together, forming unions, forming political movements, demanding change. It would take recognizing that franchisees and workers have common interests against corporate headquarters. It would take solidarity across different sectors, different industries, different kinds of workers. And I want to be clear about something. This is not about hating individuals. Fred DeLuca and Peter Buck were not evil people. The executives at Subway Corporate are not evil. The private equity investors at Rourke Capital are not evil. They're rational actors operating within a system that rewards exploitation, that rewards extraction, that rewards concentration of wealth and power. They're doing what the system incentivizes them to do. The problem is the system, not the individuals. But understanding that the system is the problem means we can't solve it with individual solutions. We can't solve it by asking nicely. We can't solve it by hoping capitalists will become more benevolent. We have to change the system. We have to change the laws. We have to change the distribution of power. We have to build alternative forms of economic organization, cooperatives, public enterprises, community controlled institutions, and we have to fight for those alternatives. The subway collapse shows us what happens when we don't. When we let capitalism organize our economy without democratic oversight, without worker power, without collective protection, we get boom and bust cycles. We get oversaturation and cannibalization. We get quality decline. We get wealth concentration. We get thousands of failed small businesses and millions of underpaid workers. And we get a handful of billionaires who extract billions from the system and then sell their assets to private equity vultures who extract even more. That's the story. That's what happened to Subway. That's what's happening across the American economy. And that's what will continue to happen until we build enough power, enough organization, enough political will to demand and create something different. The question is not whether alternatives are possible. The question is whether we'll fight for them, whether we'll organize for them, whether we'll build them. Because here's the thing about power, it never concedes anything without a demand. Frederick Douglass said that in 1857, and it's just as true now. The people who benefit from the current system, the owners, the executives, the investors, they're not going to voluntarily give up their power, their privileges, their profits. They're going to fight to maintain them, which means we have to fight harder to change the system, and we can. Working people have fought and won before. We won the 8-hour day. We won the weekend. We won Social Security. We won Medicare. We won civil rights. We won voting rights. All of those victories came from struggle, from organization, from people coming together and demanding change. And we can do it again. We can demand workplace democracy. We can demand worker ownership. We can demand economic justice. The subway story is a tragedy, but it doesn't have to be our future. We can learn from it. We can understand what went wrong and why. We can see how the system functions and who it serves. And armed with that understanding, we can organize, we can fight, and we can build something better. That's what I believe. That's what history teaches us. That's what the struggle for economic democracy is all about. And that's the story you need to understand. not just about Subway, but about how capitalism works, how it exploits, how it concentrates wealth, and how it inevitably creates the conditions for its own collapse, but also about how we can build alternatives, how we can organize differently, how we can create an economy that serves human needs rather than profit accumulation. That's the choice we face. That's the struggle ahead. And it's a struggle worth fighting.